Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to share some stories or case studies, if you like. And the hope is that these stories succinctly articulate why using or taking a holistic approach towards building wealth generates lots of value. And really, when we think about it, a lot of financial decisions include several interrelated considerations and consequences. So, for example, when you're contemplating doing X or Y, often there's financial planning implications, cash flow, taxation, borrowing or borrowing capacity, and so on and so forth. So, taking a holistic approach makes sure that you optimize all those factors so that no opportunities get missed and no risks slip between the gaps. Now, what I don't want to do is for this podcast to come across like a sales spiel or anything like that. In fact, I'm always very careful not to, talk about my business or try and sell our services during this podcast, as any listener that's listened to a few episodes can attest to. The only reason I want to tell these stories is I think they resonate and they give some real life examples of how taking a holistic approach has generated a lot of value. I mean, you can talk in generalities or in principles, but until you really share stories, sometimes the penny doesn't always drop. So I picked out 6 client stories to share with you today. Of course, we're not going to include any, financial information or identifying details to protect our clients' confidentiality. But I hope, you'll have a think about some of these stories and see if they resonate with you. And if they do, really start thinking about adopting a holistic approach yourself. So what is a holistic approach? Before I get into the stories, let's talk about that. Traditionally, financial services has been very siloed. If you have a tax question, you go and ask your accountant. If you've got a mortgage structuring question, you ask your mortgage broker or banker. Well, hopefully you don't ask your banker for too much advice, unless you've got a really experienced banker, but there aren't many of them left in the banking network anymore. But if you have a super question, you ask your financial advisor, and you kind of get my point. And the problem is that as professionals tend to silo themselves, that if you go and ask your accountant a super question, oh, sorry, that's not my area of expertise, I can't answer it, which is fine, which is the correct answer if they don't have the expertise or license to be able to answer it. But the point is that it tends to be quite siloed. Now, if we all understand that many issues, not all, but many issues are interrelated, then the problem is that you're going to miss opportunities and miss risks. That is, not deal with all those risks. So what seems like a really basic mortgage question, for example, could have significant taxation or even financial planning consequences, which of course you cannot expect your mortgage broker to have the necessarily knowledge and experience to address. But if it doesn't get addressed, you don't know what you don't know, and things get missed. So a holistic approach really recognizes that financial decisions, many financial decisions in fact, require a multidisciplinary approach. Okay, that's the theory. Let's talk about how it plays out in practice. And to do that, let me share 6 client stories. So the first one's really about integrating a business plan with a personal financial plan. So this client recently started a professional services business, was kind of 1 to 2 years into it when he first approached us, and he was achieving some excellent results, which was fantastic, but then created some tax planning opportunities or challenges, as well as working out, okay, what do I do with this cash flow and how do I really build wealth to secure my family's future? So he was able to articulate what his business plan looked like, in terms of from a financial perspective, but also from a risk perspective and a growth perspective. And doing that gave rise to 3 beneficial outcomes. The first one is that we could consider his business income structure and make sure it had the flexibility to deal with the growth that he was expected to go through, and then deal with the increasing taxation liabilities as a result of generating more profit. Secondly, we developed a long-term strategy which really addressed then how to distribute that profit, current and future profit, so that he was able to achieve his business and personal goals, which included upgrading the family home. And finally, and perhaps most importantly, we developed a financing strategy that was coherent with the rest of the tax and wealth building strategies to ensure that his plans could be implemented, so that we were going to be able to present a really strong case to the bank to allow him to borrow money and really leverage that higher income. So this sort of integrated approach, if you like, helped him optimize, tax, helped him build wealth, make sure that didn't come at the cost of compromising borrowing capacity. And it's a good example of how a client going through a substantial change, firstly starting his own business and then enjoying a lot of success, can create a lot of opportunities, but a lot of those opportunities are interrelated. Okay, the second one, second example that I want to share with you, which is, I guess, a little bit similar to the first one, is where we try to help clients do both save tax whilst also maximising your borrowing capacity. Look, sometimes you can't do it perfectly well and you've got to find a balance in between those two priorities, but it's really about optimising both. And you'd rather pay a little bit of extra tax to get a lot of extra borrowing capacity, because sometimes being too blind or too focused, I should say, on taxation outcomes can, you cut your nose off to spite your face. So, it's great you save a bit of tax, but if you can't actually put your income and assets to work through borrowing capacity, then it's really not going to serve your long-term goals. Now, the problem is that accountants don't necessarily recognise that fact. And then also they don't necessarily have the information or knowledge on how different lenders will assess different scenarios, and how different lenders attract, or I should say actually different clients should be placed with different lenders because they're more suitable and because of the way that they approach a credit assessment. So, and that's not a criticism on accountants, they're not mortgage brokers. So, of course, they're not necessarily going to know those, understand those considerations. But the reality is that you, the client, ultimately want to save tax, but then don't want to jeopardise being able to implement your other plans. So, in this situation where our client needed, in fact, the advice to him was to purchase a couple of properties included in upgrading home, it required him to take on a substantial amount of debt, which was fine for his circumstances, particularly his income. And as a result, our accountants work very closely with our mortgage brokers to make sure that we first identified the right lender for him, and then made sure that we structured the income to save tax, but also to make sure that it wasn't going to create problems with that particular lender in terms of reducing his borrowing capacity. And really, we were able to, in this situation, really reduce tax as much as possible, whilst also preserving his full borrowing capacity. So it's incredibly powerful. I think when your mortgage broker speaks to your accountant, which is, I don't see it happen very often unless they're on the same team, of course, but when they speak together, that's when you get to optimise outcomes. Okay, the next example was a dentist in Adelaide, in fact, and he approached us initially because he's interested in getting some financial advice, but we identified that there was several matters that needed to be, optimised or fixed, really, before we were really in a position to give him some advice. In addition, he was contemplating building a new family home. So it was going to give rise to additional debt, but also, needed to make sure they had the borrowing capacity to be able to execute on that. So we worked with this client initially to fix everything up. So we fixed up his business income structures. We helped him on the borrowing capacity mortgage broking side to make sure he was able to line up sufficient finance to continue with that goal to build his home. And also, his insurance was poorly structured and inadequate, particularly given the change in debt. So he wanted to make sure his family was protected. And of course, we were happy to help him do that. And that took about 1 to 2 years, probably close to the 2 years, to go through all those processes and fix everything up. And it wasn't until recently, in the last few weeks, in fact, that we said, yes, now you're ready, we can start delivering financial advice and develop a long-term plan so that he can start repaying that non-deductible debt and also make sure that he puts his cash flow to hard work. So this preparatory work from the whole team, really, it required a number of disciplines to be able to help this client and get him in the position to be able to, so I was able to develop a long-term plan for him. It was incredibly important that it was all coordinated, that all these things were fixed in the right order and they all sort of talked to each other. So we knew, the insurance advisor knew how much insurance he needed because we know, how much the mortgage broker was getting in terms of additional lending to fund the home construction. And the accountant needed to know, what his income needed to look like in terms of structure and so forth to prove to the bank to get the loan. So, it's all interrelated, and the team had to work together to really deliver that really good outcome. And really the client's now in a much, much better position now, where everything's in order and optimised, ready to begin the new journey of building a long-term strategy. Okay, the next example was working with a young dentist, in fact, that worked in New South Wales. We met her after she only had a few years of experience and was really just starting out, but earning a really good income and very good at managing cash flow. So didn't spend a lot of money, so had a strong surplus investable cash flow. And we started working with her, initially buying investment property, then sorting out super. Then she became a financial planning client after a bit of time. But in the back of her mind was to buy or start her own private practice, her own private dental practice. So in terms of providing financial advice, we needed to make sure that we had, sufficient borrowing capacity and a strong enough financial position to be able to action that opportunity should it arise. So we were helping that client with not only taxation advice, financial advice, mortgage broking, insurance, so really very much holistically. Lucky enough, she was able to find a great practice to buy into. She bought 100%. And we were able to complete the due diligence, the financial due diligence around that purchase, structure the business and so forth, structure the finance for paying for the acquisition, and really provide that holistic advice, except the legal work. Of course, we needed lawyers in order to do that. But it really was a team approach, not only for that transaction, but really leading into that transaction, fully understanding where a client's heading and making sure our advice was going to be congruent with those goals and strategies, so that she was well positioned to take advantage of that opportunity when it arose. And again, I think it shows that holistic approach really does help a person maximise their opportunities and particularly avoid making mistakes. One of the problems in that she could have had to deal with if she didn't get that advice is maybe she would have overinvested during that time. And then she would have found herself in a situation where she might needed to then sell assets, which is, it destroys wealth by doing that. So making sure you've got a long-term plan and executing on it, having the discipline of knowing when to invest and when not to invest, I think is really powerful and really valuable. Okay, the next client example is a retired partner of a global professional services firm. He approached us just when he started retirement. He had a number of different assets, property assets outside super, and a lot of cash and shares inside super. And really, we needed to develop a long-term strategy so that he was able to enjoy a retirement that allowed him to spend a significant amount over the next 10 to 15 years, travel and enjoy it while you can, while you've got the health, and then a lower amount thereafter. So it was important then to make sure that we really understood, how to invest those assets in terms of what risk profile, and making sure that we did so that provided him the longevity, the comfortableness to enjoy a safe retirement, but also still allowing him to spend as much as he wanted to in those early years of retirement. And really, to be able to derive that strategy really required an integrated approach between financial planning and tax, because there was a number of considerations, land tax, capital gains tax, stamp duties, what they call Div 7A loans, so intercompany loans, those sorts of considerations, but also at the same time making sure that, we still preserved enough assets, and then how do we reinvest those assets as well. So it's good we were able to deliver that strategy while optimising as much as possible those considerations. And I think putting someone in a position where they feel comfortable that for the next 10 years they can spend twice as much as they normally would just because they want to travel and enjoy life, and giving them the confidence to be able to do that. I think there's quite a bit of value in that, whilst at the same time, minimising taxation, stamp duties, land tax, those sorts of things makes good sense. And finally, the last example of a client really reminds us of probably the common complaint we get from clients is that, what they want from their accountant is proactive advice, and they don't often get much in the way of proactive advice. So in this client circumstance, our accountants identified that the client had some direct shares in a non-trading company, and as a result of that were missing out on the franking credits, the imputation credits that you get from dividends. And a quick conversation with the financial planning team determined that, hey, probably the best way to solve this problem would be to make an in-specie contribution of these shares from the company into their super fund. And by doing that, wasn't going to give rise to any capital gains tax consequences because they had some carried forward losses. But the benefit was that we moved it into a zero tax environment, being their self-managed super fund, and they were able to enjoy the benefit of their imputation credits, so greatly increasing their income. Now, the benefit here is the client didn't have to be involved in the conversation, until the end, until the advice was formulated, and of course we presented it to the client. But the point is that if your accountant and financial advisor are working in the same team, that's just a conversation that they can have at any point in time. And they can develop the strategy and maximise the opportunity, and then really just present it to you. And our client just had to say, yes, let's do that. And they didn't have to lift a finger or do anything. So it's a good example, again, how you have a collaborative approach that's holistic, on the same team, is going to deliver that value. So there you go. That's 6 examples but really, in reality, we come across at least an example a day where we're able to deliver value to our clients, which is incredibly rewarding. I guess there's a few points to leave you with. The first one is working in the same office just isn't the same as delivering a holistic solution. So it doesn't just happen. Unfortunately, it really is too easy to get focused on the work at hand without really seeing the big picture. Delivering a holistic approach really requires a lot of collaboration, and it's a lot of work. To be honest, a lot of reminder, a lot of systems, a lot of processes, those things that need to be really followed through. And so there is a lot of effort in order to do that. Now, it's easy to say that you do it and harder to actually deliver on it, which is not to say, ProSolution's the only firm that can do it or does do it, but it's something to be mindful of. Just because, we put a financial planner in the same office as an accountant doesn't necessarily mean you're going to enjoy those outcomes that I've spoken about today. Now, also, sometimes people mention, look, I like the fact that I've got a different firm giving me financial advice and a different firm dealing with my accounting requirements, and the separation hopefully keeps each firm honest in that if something goes wrong or someone's not doing their job, that it'll get picked up. Look, whilst that principle has merit, in reality, unless one of those parties is doing something incredibly wrong, so obviously wrong, unless that happens, it's probably not going to get picked up. It's not likely that a financial planner is going to really go through with a fine-tooth comb a client's taxation returns, and vice versa. The other thing that's really going to stand out if someone's doing something, investing in highly speculative investments or doing something like that. So in reality, if you're dealing with a good quality accountant, a good quality financial advisor, having that separation really probably doesn't provide a lot in terms of value. But the consequence of that is that you miss out on that holistic approach, that collaborative approach. I started ProSolution 20 years ago. Over that time, I've only ever had one accountant pick up the phone and speak to me because they wanted to make contact with their client's financial advisor. So that's only happened once. If it doesn't, it's hard enough to get it to happen in the same firm, let alone two external parties collaborating together. Doesn't happen, so that's the consequence associated with that, which is fine if that's what you want, if that's gives you lots of comfort having that separation, but just recognize that is the potential cost associated with that. Okay, so just to wrap up, hopefully these stories give you a good indication of the power of a holistic approach, and it's something that we hope to inspire our clients to take on and implement. Of course, the complexity of your situation really determines, or will determine mostly, whether a holistic approach or how valuable a holistic approach will be in your situation. So look, if you're an employee with very few investments and very simple circumstances, a holistic approach might not provide a lot of value. But if you're self-employed and you have a complex business income structure, for example, then you're probably mad not to employ a holistic approach. So that would be the first comment. Obviously, consider your own complexity and whether this approach sort of suits you. Now, if you don't take a holistic approach and you're using different advisors, then really you've got to understand that the responsibility to, one, identify all risks and opportunities, and two, determine what information is relevant to which advisors and when they need to be informed, all rests on you. Now, unfortunately, a lot of people don't have the skill and experience to identify all risks and opportunities and identify what information is relevant and not relevant. So that can be problematic, and that's why I think risks and opportunities fall between the gaps. But just recognize that there is value in doing that, and if your team isn't taking a holistic approach, then the responsibility rests on you to execute on that fact. Okay, that's it from me for this week. Until next week, bye for now.